What's going on, everyone? I wanted to do a review of the trade I took here in the morning session, top-down analysis, AM session protocols, and go ahead and break it down from A to Z for you guys. So taking a look at the weekly chart here, we have this weekly fair value gap that we traded down into on FOMC yesterday. Also into this down close candle, so that's a key level that I'm going to carry throughout my time frames. Daily time frame, I will take off the weekly level now. These were the two main levels I was using in my trading today. Obviously several more here with the new day opening gaps, but I'll go ahead and touch on that here in a moment when we get into the lower time frames. So what I was using was this down close here, these two consecutive down close candles. On the buy side of the curve, that's a bullish order block, right? We trade down into it, uses it as support, and then we launch higher. However, once we get below it and we close below it, if we're going to see bearish order flow, then this level here that was a bullish order block is now going to act as a bearish breaker. So what I'm extending through is that opening price here from this candle, or the lowest body inside that range. Also using this daily fair value gap, you'll see how that's influential in the lower time frame. Is the same thing with the bullish order block turning into a bearish breaker. Every PD array has an inversion aspect to it when the order flow changes, right? So how we use this fair value gap here is support. We now got below it, so I wanted to see if that can act as resistance, and you'll see how I use that to frame my short setup here this morning. All right, so hourly time frame, they just sunk it lower on FOMC, clearing out all the sell side here, here, and here. Keep in mind what that thick black line is, just working with a few levels here this morning. That is the opening price on the daily chart. You'll see what other level it overlaps with here in a minute, but you'll see that made the high of the AM session inside of that daily inversion fair value gap. So we traded up into it, couldn't get above it, selling off for the AM session. And as far as longer term perspective, is this going to be a long-term high and we sell off and this is the top? I'm not going to call that yet. I still want to see how we trade inside that weekly fair value gap for NASDAQ. But right now, extremely heavy based off the displacement we saw yesterday. And that's what I was using for a bias this morning. Another thing that also helped me with the bias, right? It's not just that. It's not just a standalone thing. I'm also using the opening range gap, right? So the fact that we had a 200-point gap higher, that also serves as a draw for the market to want to trade down into. So dropping down into the 15-minute here, we now want to look at time, right? So 9:30 open. Begins the AM session. So we did what at 9:30? The market trades higher. We had two smooth highs here on the buy side. And again, if you guys recall the protocols that I share for how I trade the AM session in the free YouTube video, I'm marking out my liquidity on the 15-minute time frame, right? Because that's the liquidity that the algorithm will refer to. And if it's session-based, it's even better, right? Like for example, here we have sell-side liquidity. This would be London lows, right? So I'll just label that, abbreviate that with LL. Again, these are exercises you want to do every day in your back testing and in your review so that you can get to a point of anticipating this, right? But it doesn't happen until you see it multiple times. So at 9:30, right, because it's still always time before price, it's not just marking out highs and lows. You have to understand highs and lows within the context of time. So at 9:30, they shoot it up higher into the buy side here and into that daily bearish breaker. We also have a 15-minute fair value gap here. So the more levels you have around a certain area, the more sensitive that range is likely to be. So what am I labeling here? That 15-minute fair value gap. You see how we trade up into it. So we've done two things. We've taken out buy stops and we've traded up into a premium inefficiency or an inefficiency above market price at 9:30. When they left equal lows here, the market is extremely heavy. Looking at the sell-off here from yesterday. And then we reject, right? So now it's, how do we trade at these key levels, right? We have the smooth lows here. Okay, but that's not enough to just go short. You want to see what they do at 9:30. 9:30, they send it higher into that 15-minute gap above the buy side, and then we aggressively break down. And you can see on the 15-minute, we have a high, higher high. That's a bearish breaker here. I'm not going to have these levels on the chart. These are all things that you can study. Bearish breaker, we trade back up into that, doesn't get above it, and we sell off. And then we attack the London lows. All right, so keep in mind the levels, not too many on here. 15-minute gap, equal highs, and then the London lows down here. At 9:30, they shoot it higher. We aggressively break down. This is the shift in market structure. When we're bearish, market retraces, then we have a 5-minute breaker here, right? So how the 15-minute breaker is just made up of this last down close. On the 5-minute, it'll be these 3 consecutive down close candles. That would be the breaker represented on the 5-minute time frame. Market trades up into that. This is where I'm shorting in a 1-minute chart, aiming for the lows down here after the shift in market structure, after we took out buy stops, right? So buy stops taken, shift in market structure. No fair value gap on the 5-minute. Again, that's why I like to zoom in with intraday, like 1 minute, even sub 1 minute. Like I took my entry using a 15-second breaker block, because again, once you know where the market's drawing to, everything works, right? Your inversion fair value gaps, your turtle soups, right? This is a turtle soup. Your breakers, your order blocks, right? All those levels work when you have an understanding of where the market should draw to, right? That is always going to be number one. So let's drop down to the 1 minute. So we're going to take off that line here and then put the 9:30 open, so you can see that here with the vertical line. All right, so 9:30 open, they take it higher again here into these smooth highs, right? So keep the levels in line, right? We have equal highs. They run up into that, and also that 15-minute fair value gap that also overlaps with that daily breaker, right? These are all levels that line up to confirm what I'm looking for. I'm going to go ahead and take this level off here real quick. I want you to study what happens here at that 15-minute gap. We trade up into it, then what do you see? The market's unable to get to midpoint. The fact that it can't get to midpoint or even lay a body inside of this fair value gap is telling you it's extremely heavy. It's bearish. So when we displace and aggressively reprice away from it, we shift market structure, we retrace back up into the range into this last up close candle. That's a bearish order block. And then once we break down again, I'm selling short in here with the stop loss above here. And I'm aiming for the obvious equal lows here. Also, you'll notice there is a opening range gap, right? So from where we closed the previous day to where we open at 9:30, also using mid gap as a draw. So mid gap is the first draw. Through that, I like the London lows. And in this particular session, was looking for very low hanging fruit. Reason being, if you look at the morning session from 9:30 to 11:30, see a relatively sloppy section, right? A lot of back and forth, a lot of high resistance liquidity run. Like it's still dropped, it's still bearish, but look at all the deep retracements here, 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 here that you wouldn't normally see on a low resistance liquidity run. Very important being able to identify that. What told us it was going to be high resistance today? The fact that we had a large range day the previous day, right? And then what do you see when we get into the session? Look at all the overlapping candles, right? Fair value gap closes it in all the way and then spends a lot of time inside it, right? This fair value gap here. Market spending a lot of time inside the gaps, things you don't want to see in a low resistance liquidity run, right? So this indicates it's high resistance. Doesn't mean it's not tradable. It's just you have to be willing to endure a lot of deep retracements and a lot of back and forth price action. So with that, once we traded higher, we respected this first fair value gap here. You'll see the bodies stopping perfectly there. Those are algorithmic confirmations I look for. Then from there, we aggressively get sent lower. Retraces up to the order block. I'm taking a breaker entry in here. So let me go and show you where I took my entry. So once we traded higher, we broke down from the first fair value gap as we were trading inside this 15-second breaker. I'm selling short in here. And here you can see my executions. Shorting inside this breaker, covering one here at the low, covering one here at this low as we made a lower low, running down equity, and then closing the rest out here at the London session, equal lows that we had back there. So this is the live execution, and as always, live account. Back to what I was sharing here though. go back to this here. So breaker, selling short in there. As we take out these lows here and we trade to the midpoint of that regular trading hours gap, I'm covering one more there. And then the last one comes off, or the last two contracts rather, come off at the London sell side liquidity. What are other things up here that also told me we were bearish, right? If you'll recall, I gave you the let me put that level back on. Bearish breaker here on the daily time frame. Could make that 3. So that thick black line, we're about to see that on the lower time frame. That is also this new day opening gap here. So that's why I was using this new day opening gap specifically, as you'll see in the live execution. I'm using that new day opening gap, and the fact that we hit that like a brick wall and break down, that's indicating to me we're bearish. So several factors here. You don't need all these factors, right? That's one thing I want to remind you of as well. There's a lot of things in my analysis that I'm using to complement what I'm looking for, because I know what I want to see. And if I get all those confirmation factors, it just puts the probabilities in my favor, right? One of the things I always talk about is trading is a probabilities game. So if you can put the probabilities in your favor, more so than not, what's going to happen to your win rate, your strike rate, and your precision? Naturally, it'll go up, right? So you don't need all these levels, but if I have them behind me, then it just makes this a very high probability trade, even in a tough day. So we trade up again, we clear the buy side, we trade in that 15-minute gap, which is also that daily bearish breaker. And you'll see there with that there with the new day opening gap, you'll see me use that live real time, using these insights to make real money, like the type of money you transfer over to your bank account. And then we get the market trading down into the lows here. And then you'll see that daily fair value gap. Now taking these other levels off, you'll see that daily fair value gap, how it's working. These levels really sloppy back and forth, not the easiest day for precision elements in your trading, but nonetheless, you're still able to get what you're looking for if you know how to manage the days correctly, right? So in a high resistance liquidity run, how do I manage these particular days? Number one, I size down immediately. I do not want to be in high leverage trading a high resistance liquidity run. Secondly, I take partials quickly. So as soon as the market runs in my favor, it puts money on the table, I'm taking it because of the nature of this type of day, to deeply retrace and give a lot of consolidations. So by sizing down, by taking partials aggressively, I'm then able to ease the nerves, be calm, cool, collected, and take down the opportunities when they present themselves. But not every setup I'm willing to allocate the same amount of risk, because there's certain days where it's lower probability like this, where I still see my model, but I'm still willing to put the risk on the table because the model's there, it forms, it wins more than it doesn't, makes me more than it loses. So that's all I'm here to do. Execute the models when they form. However, there's certain days I'm willing to risk more or risk less or trade a lot more based off what I'm anticipating in the price delivery. Hope this one was insightful. See you on the next one. Take care. So with that in mind, we traded, like I said, to a discount of the range. We have a mitigation block here. I'll be seeing how we trade in. That'll be an influential level for me. Why is that a mitigation block? Because it was an order block on the buy side of the curve, right? So if we're going to be bearish, then it is going to show signs there. If it's going to be bullish, it'll trade through it, right? So it's not a matter of having to guess or predict what the market's going to do. Just let it tell you simply what it's going to do, right? These are things we do every single day on 1 minute, 5 minute charts. And you guys can see reading price action is universal. You know how to read the lower time frame. Well, you know how to read the weekly, the daily, and it all comes together for you. And we have this 15-minute gap here. We'll go ahead and extend this one through. And then we have a 15-minute gap here. We'll extend this one through, right? So if we're going to get up here to this best case target here, right? It's very simple. What's the market going to do? Get above this gap, use it as support, get to this gap, use it as support, and reach higher, right? Very simple stuff, things we do every single day. So that's what the market's going to do if it's going to get up there. But if it's not going to get up there, what's it going to do? Hit one of these premium levels, confirm weakness, and then these things will be able to decipher in the lower time frames, right? So it's just a matter of taking what the market's giving you, understanding how to read the charts. So again, reaching that 15-minute gap, unable to get above it though, so still watching. All right, so let's say we were considering bullishness. Well, what would I need to see? Get above that new day opening gap, right? Support, reach this one, get above it, right? Show strength. What's it showing now? Weakness, right? It's unable to get above that new day opening gap. It's unable to get above that 15-minute fair value gap. So that's why the levels I share with you guys, they work. And it's not because I'm just using one fair value gap. Many times I'll have other levels that converge. So if I have like this new day opening gap here inside this fair value gap, then that tells me this is going to be a key influential level. But everything here is indicating what? Weakness, right? Because it can't get above this 15-minute gap. It can't get above the new day opening gap. So then what would we look for? Sell side down here, right? Sell side here, and then mid gap down here. You see how we're able to predict these price runs because we know how to read price action. Run on buy side, couldn't get above the 15-minute gap. And now we have sell side here and then mid gap here. So we have this first imbalance here. We want to see how we trade there as we get up into that level. All right, so you can see we traded up to the high of that fair value gap. It's not ideal that we traded all the way up to the high, but you see the body stopping there perfectly. Now we're breaking back down through that fair value gap. So now mid gap is in play, that 0.5 level. And then again, that sell side back over here. That's all in play now. All right, so I'm going in with 5 micros here. Gonna take a low risk short in here. See if we can get a flush down into these lows. And then I will take a partial at mid gap. All right, so I'm going in very light risk here today, guys. All right, so my stop loss will be up here. I wouldn't want to see it trade through both of these fair value gaps and still sell off. So I like how the bodies are staying below midpoint of that gap. It needs to accelerate though. It's been really sloppy here in this open so far. A lot of back and forth. Again, that's why I'm in with light risk. Do like what I'm seeing here. I like how the bodies are stopping at the midpoint of that first presented gap. And now they left equal lows here. Mid gap and then that sell side down here. So you'll see this wick here. That's a premium wick. I like how we opened, traded up into that. Couldn't get above it. Now I'd want to see the market stay heavy from here. All right, I'd want to see acceleration from here. We have a new day opening gap here. I'd want to see us close down through that. That's why I'm saying we need to accelerate here. I don't like how it's spending all that time inside that gap. I want to see it smash down through that, close below new day opening gap. Because then if we do that, then that's going to tell me we're very likely to smash into those limit orders that I have. All right, there you go. That's first limit order, pay the trader. I'm going to trim risk even more though. No need for the market to come all the way back up here. This new day opening gap here, this should act as a barrier on price. It should not let the market get up through that. So that's why I'm trimming risk here. So now what I want to see is I do not want to see us close above the new day opening gap. The fact that we already traded down through it, we should just keep selling off and slipping off the face of the earth, but it's not doing that. So that's why the stop's up here, because this should not get through new day opening gap and through this up close candle if it's still going to get down into here. All right, I'm going to run down some equity here. Let me buy back one more. All right, so I just bought back one more here below the low. So we have this fair value gap here. I'm not willing to see the market trade all the way through that. So I'm reducing risk here. So now I can finally say it. Worst case scenario, we're making money. We anticipated doji. So I want to see this candle be a doji, and I don't want to see this candle's high taken out. Why can I anticipate this being a doji? Because if we're bearish, the draw's here, and we trade into a fair value gap or an order block, you can anticipate that being a doji. Ooh, you can anticipate dojis? Absolutely. If you know where it's drawing to, you have a key level. In this case, we're using the fair value gap. We want to see that be a doji, be a reversal candle. Boom. Most random. So selling short inside this breaker here, covering 2, 1, and then 2 here at the low.